The worst million-dollar investments in 2021. Hello, lovely YouTube family. Welcome back to Lux King. In today's videos, we're going to talk about the worst million-dollar investments in 2021. But before we start, I would want you to hit that red subscribe button so that you never miss out on any of our videos. Number 5. Peco Capital. Founded in 1998 by Art Sandberg, Peco Capital wowed investors with annualized returns of more than 16% a year, growing to more than $15 billion under management by the early 2000s. However, it turns out that this impressive track record was the result of insider trading. The SEC brought charges against the fund in 2010 and fined Peco and Sandberg $28 million. Number 4. SAC Capital. SAC Capital, run by Stephen Cohen, was one of the leading hedge funds on Wall Street with $50 billion in assets under management (AUM) at its peak. The SEC had been investigating the hedge fund for a number of years before conducting raids at offices of investment companies run by former SAC traders in 2010. A number of traders at the fund were charged with insider trading from 2011 to 2014. Former portfolio manager Matthew Martoma was convicted of conspiracy and securities fraud in 2014. In total, 8 former employees of SAC Capital were convicted. The SEC never brought charges against Cohen personally, although it did file a civil suit against SAC Capital in 2013. SAC Capital ultimately agreed to pay a $1.2 billion fine and to stop managing outside money to settle the suit. As of April 2021, Cohen runs Point Asset Management, which manages his personal wealth of around $10 billion. Number 3. The Galleon Group. Galleon was a very large hedge fund management group with over $7 billion in AUM before closing down in 2009. The fund was founded and run by Raj Rajaratnam. Rajaratnam was arrested along with 5 others for fraud and insider trading in 2009. He was found guilty on charges and sentenced to 11 years in prison in 2011. Over 50 people were convicted or pleaded guilty in connection with the insider trading scheme. Rajaratnam was tipped off to an investment of Warren Buffett was making in Goldman Sachs by Rajat Gupta, a former director at the investment firm. Rajaratnam bought the shares in Goldman before the close of the market that day. The deal was announced that evening. Rajaratnam then sold the shares the next morning, making around $900,000 in profit. Rajaratnam has a similar pattern of trading with other stocks with a ring of insiders who supplied him with material information from which he was able to profit. Number 2. Long-Term Capital Management. Long-Term Capital Management (LTCM) was a large hedge fund led by Nobel Prize-winning economists and renowned Wall Street traders. The firm was wildly successful from 1994 to 1998, attracting more than $1 billion of investor capital with a promise of an arbitrage strategy that could take advantage of temporary changes in market behavior and theoretically reduce the risk level to zero. But the fund nearly collapsed the global financial system in 1998. This was due to LTCM's highly leveraged trading strategies that failed to pan out. Ultimately, LTCM had to be bailed out by a consortium of Wall Street banks in order to prevent systemic contagion. If LTCM had gone into default, it would have triggered a global financial crisis due to the massive write-offs of its creditors that would have to be made. In September 1998, the fund, which continued to sustain losses, was bailed out with the help of the Federal Reserve. Then its creditors took over, and a systematic meltdown of the market was prevented. And at number 1, Madoff investment scandal. The Bernie Madoff scandal is truly the worst case scenario for a hedge fund. Madoff was essentially running a Ponzi scheme with Bernard L. Madoff Investment Securities LLC. Madoff was a well-respected investment professional throughout his career, although some observers questioned his legitimacy. He even served as chair of the National Association of Securities Dealers (NASD), a self-regulatory organization for the securities industry, and helped to launch the NASDAQ exchange. Madoff admitted to his sons who worked at the firm that the asset management business was fraudulent and a big lie in 2008. It is estimated the fraud was around $65 billion. Madoff pleaded guilty to multiple federal crimes of fraud, money laundering, perjury, and theft. He was sentenced to 150 years in prison and a restitution amount of $170 billion. While many investors lost their money, some of them have been able to recover a portion of their assets. Madoff operated his fund by promising high consistent returns that he was not able to achieve. He used money from new investors to pay off the promised returns to prior investors. A number of investment professionals questioned Madoff and his alleged performance. Harry Markopoulos, an option trader and portfolio manager, did substantial research and determined Madoff's results were fraudulent. He reached out to the SEC numerous times over the years, providing evidence of the fraud. However, the SEC brushed off the allegations after minimal investigation. Madoff died behind bars in April 2021 at the age of 82. And that's all for today, folks. I hope you liked the video. If you did, make sure to hit that like button and subscribe to the channel so that you never miss any amazing videos from us.